Hey, Candace.
Good morning.
How are you?
Awake.
Cool. I'm not putting my video on today.
I swear, it's bittersweet, this. I can roll out of bed and just like sign in, but
I know. No.
rough.
Sometimes I'll be driving to work on, oh, look at that person just going for their paper, you know, oh, that's,
Yeah.
I could just work from home like that. And now I'm like, oh, shit.
It's driving me nuts.
I know. Oh, well. Hey, so I'm going to get started. It's you and me, and that's great.
Okay.
I was going to go over 18.5, and then I wanted to go over one more. We'll have time. So it's going to be problem 18.3, which is on Treasury stock and that, just so you're comfortable with it. And then that'll be it for today. Then we're done. So I know one of the groups was thinking, I don't know, you know that the paper isn't due till next Thursday?
Oh my God, I thought it was today.
Okay, so you're another group. I swear I put it out there that, so, you know, if you guys have it together, you want to wait on it, you can. If you're like, okay, it's done, I want to submit it, that's fine. But no, you have another week if you want to find.
Oh, I'll definitely take that extra week then.
Yeah.
I really just feel like we kind of just pulled it together, and I'd rather just like go over it and add a few things. Like, I know that we were supposed to do the ratios and we didn't, so I can do that today.
Oh,
I was like nervous
yeah.
I wouldn't have time to get the ratio part done. So like I
Yeah,
had
no.
it done, but I had to do the analysis of it.
Yeah, I'll send an email out to everyone just reminding them. I thought I did it in the announcements. Maybe I did it on like a lecture and, you know, some people don't, whatever. Or if they're listening to the other video. But yeah, I figured since we're not doing the presentations, the only reason I needed the papers today was because we were going to have a panel and they were like, we would like to read what they're going to be talking about first. So could you get that information to us? And I was like, yeah, okay, I'll just make it do a week earlier. And
okay, I see.
yeah, so now you guys have that extra week. Noon on the 14th.
Beautiful, beautiful.
Yeah, and then let me just give you one more. I think, I can't remember when I have the final due for. Let me just double check on it. Because it's all running together for me too. Where do I put that? What the heck? Oh. Yeah, okay. Standard. There we go. Holy shit, Lisa. Oh, there it is. Okay. So, I thought I changed it on here too. Yeah, I changed it on that updated schedule, but I guess people. Okay. But the final.
I probably never even looked at the schedule, to be honest. I'm a mess.
Nah, that's okay. Final exam though will be due on the 13th.
Okay.
Wednesday, and then homework for this tableau, you know, any kind of tableau. I don't know if you have to worry about the tableau, but
I did it actually. I did all three of them.
Oh, good. I'm glad. Yeah. I just want you to be.
So am I. Oh yeah. Man.
And I wasn't going to have you holding off on finishing up the class for 3 tableau, you know.
Yeah.
Unique situation. So it is what it is. But
thank you.
When we do get back or you get access and you're able to, I encourage you to go and look at that because that's a great thing to have and to be able to say to someone, hey, I have worked in Tableau. You know?
Right. I need a new laptop. It's terrible.
But even from the standpoint of reading the reports on that, you should always, if you're in a job interview and you're like, oh, I've used Tableau. And if they're like, see, it'll be great if they say, well, what's Tableau? And you could say,
oh, even better. Yeah.
yeah, Excel on steroids is a great, graphic software
Okay.
for data analysis. Use those fancy words. People love it. So let me grab the answer key and we'll get going. Do you have any other questions or anything?
Not at the moment, no.
Cool. Okie dokie. Let's roll on this. Come on. I'll share my screen in a second as soon as I get this thing out.
Okay. And then I'll just mute myself once you start talking.
Okay.
My dog will start barking or something.
Yeah, I know. Mine just went for his walk, so he'll come home and start drinking his water,
And you'll hear.
Clancy, God, what's wrong with you? All right. Let me grab my screen. We'll share it. All righty, here we go. Okay, so if you have anything, though, stop me, ask away. Listed below are the transactions that affected the shareholders' equity of Ranch Rickey Corporation during the period 2021 to 2023. The December 31st, 2020 corporate accounts included the following. So there's our starting point for the year 2021. So there's various transactions through those 3 years. We know in the real world, we wouldn't be doing 3 years at once, but just for purposes of looking at the effects of different items, they do give us a 3-year period. And they ask us first to prepare the journal entries for each year. So just to run through them, let's take a look. November 1st, the board of directors declared a cash dividend, so cash, 80 cents per share on its common shares, payable to shareholders of record November 15th, going to be paid December 1st. So remember, date of declaration, whenever the board of directors promises to pay an asset of the corporation, they create a liability for the corporation the day they make that promise. So if they're going to pay 80 cents cash in the future on the shares as a dividend, on November 1st, we must debit retained earnings because that's where the dividends being, quote, paid out of, and credit cash dividends payable for the 105 million times 80 cents a share, or $84 million. So again, when we say paid out of, I remember learning this and people going, the instructor saying that and go, well, we're paying them cash. We're paying it out of cash. We're not paying it out of retained earnings. But we are, because retained earnings is just the holding place of all the assets that are available to the shareholders. So we reduce the balance of the assets available to the shareholders as a dividends, which is retained earnings, for that 84 million, and credit the liability. Now on the date of record, remember that's an administrative date. It's the ownership cutoff date. Anybody who owns the stock on November 15th at the close of business is going to get that dividend. Ultimately, December 1st is the payment date. So the cash dividends payable will be debited, the liability, and then credit cash. Okay? Cash dividends.
I have one question. Sure. And it pertains to the tableau that I did for chapter 18. Mm-hmm. It was one of these. It was cash dividend. And I put the retained earnings as the declaration date, debit, and credit the cash dividends payable. Everything was right, but they kept saying that retained earnings was wrong. So I went back and I tried additional paid-in capital, and that was wrong too. So I don't understand what they wanted me to debit on declaration date.
Yeah, let me take a look at that quick.
I don't know if it was like another glitch or something I was doing wrong. I mean, you could do it later and get back to me.
Let me take a look at it now. And it's not a big deal. You and me, so.
Yeah.
Yeah, I'm going right into your Tableau. Let's see.
Okay.
49.
Final answer I left as additional paid-in capital because I didn't know what else to pick.
Okay, requirement 2, 3, 4, 5, 6. Okay, that's not the one. It's the, question 3, was it?
I think so. I think it was the last one.
Well, that one you got 20 points on.
Why was it kept marking my answer wrong for retained earnings?
Okay, hold on. Maybe it was question 2. That one you.
Oh, maybe it was question 2.
Let me see what they're saying. Oh, they're being jerks.
Oh, okay.
Yeah.
I figured so.
Yeah, this company, some companies, if you remember back to accounting 112, use a separate, instead of debiting retained earnings directly,
Oh, the income summary.
they'll debit it and then reset it to 0. And that's what they did.
And it did say that in the directions, I think.
Did it? Yeah.
I might have read that and then forgot about it.
Yeah, I gave you the points. That's cool.
All right, thank you.
But that's what the problem was.
Yeah, because that's the same with this the 8.4. It was saying, I mean 8.5 with the income summary as well.
It shouldn't do it here in 18.5.
Yeah, it says it up here, something about income summary. Allow you of revenues and expenses using a titled income summary, but that's not for the retained earnings part.
Right. Yes.
I wouldn't think to do that.
Yeah, just be careful. If they tell you to use the dividends account, use that. But
okay.
Should be in line with, yeah, it's all, it both are right. Okay. So it's marked wrong and you're like, I know I got that right. Just, throw me an email. We'll add the points back.
All right. Thank you.
You're welcome. Okay, I'm going to go on then to March 1st, 2022. The BOD declared a property dividend, still an asset, consisting of corporate bonds of another company, Warner Corporation, that the company was holding as an investment. The day they declared the dividend, the bonds had a fair value of $1.6 million. They were previously purchased for $1.3 million. Because they were intended to be held to maturity, they're still listed at $1.3 million in the accounts back at Branch Rickey. The property dividend will be paid to shareholders of record of March 13th on April 5th. So we talked about this on Tuesday. When we declare a non-cash asset as a dividend, property dividend, we're still promising to pay an asset. So we still have to record a liability the date of declaration. It's just different than cash. Cash is always at fair value, but when we are giving an asset that's non-cash, the first thing we have to do is write it up or down to its fair value on the date of declaration. Since these bonds they're giving as a dividend have a fair value of 1.6 million and a book value, or the value on the books of the company in the T account, investment in equity securities, is 1.3, we will have to debit the investment in equity securities, 300,000, and record a gain on investment. And that is recorded on the income statement. It's basically recorded just like as if we had sold these bonds on March 1st and made a $300,000 gain on them. Treated the same way. Then debit retained earnings for the fair value of the asset, 1.6, credit property dividends payable. Notice, we are not removing the investment yet. We did not pay it as a dividend. Just like we don't remove cash up here on the date of declaration. We're just setting it up saying, hey, we're going to pay this in the future. So as of today, we have a liability and we decrease retained earnings. just like in our any other time, date of record, there's no entry. It's an administrative date. But April 5th is when the company is going to now be mailing out those bonds as a dividend to their shareholders. Debit property dividends payable, the liability you created up here, and now credit your asset account, investment in equity securities. You don't own them anymore. You just sent them off as a dividend. Okay, so pretty much like a cash dividend, except for this changing the value, making sure the asset is at its fair market value on the date of declaration that you plan on sending out. The next one, now we're switching gears. On July 12th, the corporation declared and distributed on the same day, which isn't normal, but that's the way we're going to attack it, a 5% common stock dividend. Common stock dividend, not a cash dividend on the common stock, but a common stock dividend. So they're sending out more shares of stock. How many? 5% more. Now, they're doing this when the market value was $21 a share. Cash is going to be paid in lieu of fractional shares, meaning the person doesn't own enough shares, like they own one share. So a fractional share, they're entitled to a 5% of one share. That's a fractional share. So instead of giving somebody a 5% of one share, they give them cash instead. So part of this is a pure stock dividend. Some of it is cash. And it's all happening on the same day. Declaration, date of record, date of distribution. So that's why we only have one journal entry. First thing we need to determine is how many new shares of stock, fractional and whole, are going out. Well, that would be 105 million times 5%, or 5,250,000. We value, or we use all of them to determine the total value of this dividend. Since this stock dividend is less than 20%, we use the market value of the stock to determine the total value of the dividend that must be debited to retained earnings. So that's how much of the earnings is considered to be the value of this dividend. 250 million, 250,000, 110 million, 250,000. Okay. Of that, they tell us the 250,000 fractional shares are not going to be sent out. So what does that mean? Only 5 million more shares of common stock at $1 par are going to be sent out. 5 million. The total value of those 5 million, remember, is at $21. 5 million times 21 is 105 million. The first 5 million represents par value. The excess will go into paid in capital, excess of par of 100 million. So since the shares are being sent out today, we record that. Those are considered issued and outstanding shares. The 250,000 fractional shares will be paid $21 a share. So there's cash going out as part of this dividend of $5,250,000. So the other day we didn't get to talk about if there's a cash component for these quote fractional shares, but that would be defined in any kind of problem for you. So anytime we have this, sometimes companies will do this. How do you send out, like I said, a 10% of one share? You can't, just pay them cash instead. So just so you're aware of that. Any questions on that? Okay. November 1st. Now the company decides to pay another cash dividend, 80 cents a share on its common stock outstanding. Record date, November 15th, payment date, December 1st. Now, what you have to be careful of here is keeping track of all the shares of stock. The company starts with 105 million shares. When they gave out this 5 million more in shares on the 12th, we've now increased our outstanding stock to 110 million shares. So it's the 110 million shares that will receive the 80 cents per share dividend. Debit retained earnings, 88 million, credit cash dividends payable, just like we did last year when we paid a cash dividend. But they try to get you caught up in, oh, I'll use the 105 million. No, you have to remember that you added 5 million because of that stock dividend. November 15th, date of record, no entry. Ultimate date of payment, debit cash dividends payable, 88 million, credit the cash, 88 million. So that's our transactions for 2022. Now, January 15th. The company declares a 3-for-2 stock split in the form of a 50% stock dividend. So before you had 2, now you have 3. So you have 50% more, or a 50% stock dividend. When the market value of the common stock was $22 a share. Now here you have a choice. I'm a retained earnings kind of gal when it comes to anything with dividends. So either way you handle this would be correct. But this company is sending out, they start with 110 million shares, they're sending out 50% more shares. So an additional 55 million shares are being sent out as a stock dividend. When your stock dividend percentage is above 20 to 25%, you use par value to value that dividend. And you have a choice. You could either debit paid in capital excess of par or retained earnings. Now, they give you a choice. It's really what you prefer. I'm the kind of gal that I'm like, a dividend's a dividend, you should decrease retained earnings. I take a more conservative manner about it, I guess, but overall, the total impact on stockholders' equity is the same. You're either going to decrease the stockholders' equity account paid in capital in excess of par, or you decrease retained earnings. And the reason that they debit paid in capital, or you have that choice, is because they're looking at this as you're getting a return basically on your investment. They're giving you some of the money back that you paid when you originally bought the stock. I like retained earnings, but like I said, it's either or. It's up to you. Your author likes paid in capital in excess of par and says, yeah, if you want, you could do retained earnings. But that's how we determine that. Now, the assumption here is that date of declaration, date of record, date of payment, all occurs on the same day for the stock dividend. Are you okay on that?
Yeah, I got it.
Okay, cool. So then ultimately, when your next dividend declaration happens and they declare a 65 cents per share dividend, you have to remember those additional 55 million shares that were just added. So now the dividend will be paid on 165 million shares of stock, 65 cents a share. The journal entries remain the same. Debit that retained earnings, 105,250. Now credit cash dividends payable. Now notice when it's a cash or non-cash asset being paid out as a dividend, you don't really have a choice. Retained earnings is your account. Same with small stock dividends. It's when that dividend becomes more of it's a large stock dividend that you have a choice with paid in capital or retained earnings. no date of record, and then ultimate payment date. Okay, so just wanted this problem, and this is common even for like the CPA exam. They try to catch you in stupid stuff. You can know everything and you'll be like, oh shit, I forgot to add those stocks in. And that's what they're trying to make you remember to do that step. It's all about details. So those are some great examples of practicing all kinds of dividends. What the second part of the problem wants us to do is a statement of shareholders' equity and just put all 3 years. And this is just a great review of this financial statement, which this financial statement is just taking our major categories of stockholders' equity, basically major accounts, and showing how they changed during the year. And in this case, we're going to look at all 3 years. So we have the common stock starts at 105, additional paid in capital 630, and the retained earnings 970. So if we add those 3 across, we get our total stockholders' equity of 1,705,000. The only changes to stockholders' equity during the first year we're looking at is that, and they tell us in part 2, net income increased retained earnings 330, cash dividends decreased at 84. And we would just show that impact on retained earnings individually, and then over here on stockholders' equity in total. Then in the second year, so now we have revised balances going into 2022. The property dividend decreased retained earnings 1.6. Now, the common stock dividend from our journal entries up here, right in here, that decreased retained earnings 110,250, but increased additional paid in capital and common stock. So the overall effect on stockholders' equity was a decrease of 5,250,000, and that's from the part of the dividend that was cash. Net income increased retained earnings 395,000, and then the cash dividend decreased retained earnings 88. Now we can update, okay, now our common stock is up to 110,000, additional paid in capital is up to 730,000. We added and subtracted the changes to retained earnings, giving us a balance of 1,411,150. Add those 3 across. And we also, in our shareholder equity column, show the overall or net impact of these individual transactions on total stockholders' equity. So whether you're adding these 3 numbers across or adding and subtracting the items to the beginning balance, we should be equaling 2,251,150. Now, the final area depends on where you accounted for this 55. So if you debited additional paid in capital for the 55 million for that stock dividend, the 50% stock dividend, you would have less than additional paid in capital. If you debited retained earnings, it would have been less than retained earnings. But you did increase common stock because additional common stock went out. The only other impacts was retained earnings increased 455 million, I guess, for the net income, and cash dividends decreased. Retained earnings 107,250. So now after that, our common stock is at 165. Assuming you decrease paid in capital in excess of par, it's now at a balance of 675. Retained earnings at 1,758,900. Add those 3 across, 2,598,900. Notice the net impact on overall stockholders' equity for that stock dividend is 0. Large stock dividends have no impact on overall stockholders' equity. You're basically just transferring the money, the value out of one equity account into another equity account, or in this case, paid-in capital, additional paid-in capital to common stock. So it's overall zero effect. And then, of course, the cash dividend would have an overall decrease effect, a net income increase. Okay, so that was a great exercise to go through to see the big picture of how stockholders' equity is affected by these individual transactions when it comes to dividends. Great problem for dividends. Any questions on that? Here comes my dog now. You'll be hearing him any second. There he goes.
I kicked mine outside.
Yeah, he just came in from his walk. He'll sit there for 20 minutes now drinking. Hear him? Okay. I wanted to take a look at one more problem with you since there's plenty of time here if you don't mind, and that is 10.3, just to get a nice review of Treasury stock. I know I didn't ask the class to do it, but I wanted to walk through the steps of it, and then if you had any questions, I can answer them. I think I do have something with, I know I do, Treasury stock on the test, and just wanted to do something a little bit more comprehensive than maybe an exercise. So this is on page 1092, problem 18-3. National Supply's shareholders' equity included the following accounts at December 31st, 2020. Okay, so they have the shareholders' equity, common stock is 6 million. 6 million shares are, it looks like, issued and outstanding at $1 par. They have some paid-in capital in excess of par. So they received $30 million more than par value when they originally sold the stock. And then the retained earnings is at $86,500,000. Okay. National Supply reacquired shares of its common stock in 2 separate transactions and later sold shares. So they want us to prepare the journal entries related to these under 2 different assumptions. So the first, we're going to look at it and say, okay, the company National Supply goes out, reacquires their stock and retires it. So maybe they rip some of the stock certificates up. Maybe they just put them back in the safe and said, maybe we'll sell them at some point. But as far as we're concerned, they're not sold and they're not outstanding anymore. So when they go this route and they repurchase the stock, they are actually taking the common stock out of circulation. So first, of course, credit cash. Do the thing that's easiest, right? How many did they buy? How much did they pay in cash? So credit cash for $2,400,000. Now, the assumption here is that the stock was, there's an equitable distribution of paid-in capital in excess of par, meaning that $30 million they received in excess of par was received the same way on the 6 million shares that were sold. So that means the day they sold these shares, they sold them for $6 a share, $1 par plus $5 in excess of par. So we're going to have to remove the common stock we just bought out of the market and are retiring, debit the common stock account for the 300,000 shares we just repurchased and the par value, removing it out of that account, and removing the paid-in capital in excess of par related to the original sale of those 300,000 shares, $5 a share, out of that account. So we bought these stocks back at essentially a loss. When we originally sold these, we received 1.8 million, $6 a share. When we bought them back out of the market, we paid 2.4 million. Now the rule says when this happens, look to see, do you have a paid-in capital repurchase account? We don't. So if we don't have that account, then we have to debit retained earnings for the entire loss of 600,000. If we did have that account, we would have debited it as much as we could till it reached zero for that loss. And then any excess, debit retained earnings. But since we don't have that, retained earnings is our only choice. Do you have any questions on that? Okay. If you don't butt in, I don't mean it that way, but if you don't ask, I'm going to assume I could keep going. I'm going to stick with retirement and go to the next. I'm going to ignore that part B there. So I'm going right here. In the second transaction, they purchased more shares out of the market that they're going to take out of circulation and call them retired. Now they're buying 300,000 shares, but paying $5.50 a share. So they're going to pay cash of 300,000 shares times $5.50 a share, or 1,650,000. They remove those shares out of the common stock and paid in capital account for the original amount they received. $1 par in the 300,000 debit common stock, the $5 per share they received in excess of par on the 300,000 shares, or 1.5 million. So now they only paid 1,650,000 for shares they received $1.8 million for. So they essentially have a gain because they paid less than they should have for these shares. So now we can credit that gain to paid in capital shares repurchase. So now this transaction actually created a balance in that account for this scenario. Now, the last transaction, or part A, is when the company is going to take some of those shares out of retirement and sell them back into the market. How do we treat that? Well, since we took these shares out of our accounts and acted like they were never sold before, we've got to put them back into the accounts and act like they're being sold for the first time. So when you sell 200,000 shares at $7 per share, debit cash, 200,000 times 7, credit common stock for the par value, and credit paid in capital, excess of par for the difference. You could ignore that assumed FIFO cost because that has nothing to do with our situation. Here, it has to do with the Treasury stock, the next scenario we look at. Okay, so when you reissue shares that you had retired, they have come out of that common stock account. The impact is to wash out the original sale, and we do that up here when we bring them back. So if we're reselling them, we've got to put them back out there like they've never been sold before and record them like that. Are we okay? Cool. Now, let's go under the next scenario. Let's say instead the company goes, no, we don't want to retire these. We just want to buy them back out of the market, hold them in Treasury, and resell them. We don't want to take them out of circulation permanently or even temporarily. We want them still to be actively issued shares of common stock. Now we are taking the route of Treasury stock. That's how we record it. So when we reacquire those 300,000 shares at $8 a share, we don't debit common stock. We debit the contra stockholders equity account, Treasury stock, 2.4 million. Credit cash, 2.4 million. We don't do anything with par value or any of that. Same thing when we buy the shares and we put them in Treasury again, debit Treasury stock for the 300,000 shares in the second repurchase times how much we pay for them in that second repurchase, 1,650,000. Credit cash, 1,650,000. Now, and I'm going to do a little T account on a little piece of paper in front of me, right? So I have 2 debits in my Treasury stock account right now. One is for 300,000 shares that costs $2,400,000. And the other is for 300,000 shares that cost $1,650,000. So my Treasury stock account will have a $4,050,000 balance representing 600,000 shares of common stock National Supply owns of itself. Now, on November 9th, when they sell 200,000 shares, this is where that whole FIFO cost comes into play. Because you're like, well, which ones did they sell? Did they sell the ones they paid $6 for, $5.50, a combination? We assume they sell them first in, first out. So the 200,000 they sold are from the first purchase that they paid up here $8 a share for. Okay, so they'll still have 100,000 left after this sale that cost $8, and then they'll have 300,000 that cost $5.50. So that's how we determine the amounts to be debited and credited. So first, debit cash for the 200,000 shares times $7 a share. That's what they sold them for, 1.4 million. Credit Treasury stock for the 200,000 shares from the first purchase, $8 a share. So we sold them for less than we originally bought them at. Bought them at 1.6, selling them at 1.4. So the difference, the loss, is debited to retained earnings. In this scenario, we didn't have any paid-in capital shares repurchased. So this up here, that's not in our scenario. If we had an account, paid-in capital shares repurchased with a credit balance in it, we would have debited it till it reached 0. Since we didn't, we debit the whole loss to retained earnings. Any questions on that?
All good.
Excellent. So let's see part 2, just to review this shareholders equity section one more time. And I'm going to do it from both scenarios. So first, pretend instead of holding the stock as treasury stock, what would stockholders' equity have looked like if they retired them? So I think they did it for each. Which year are we doing it for? Oh, they just want to know what shareholders' equity section of National Supply's balance sheet at December 31st, 2023 would look like. So this isn't a statement of stockholders' equity, just the stockholders' equity. So here is, here's where we want to focus our attention first. So doing T accounts could really help us here, remembering the impact on our common stock and stuff. So I'm just going to go back up here, reminding us that we started with a $6 million balance in common stock and a $30 million balance in paid-in capital. In retirement, and a $86,500 in retained earnings. In retirement, the company would have decreased common stock $300,000. They would have decreased the additional paid-in capital $1.5 million, and they would have decreased retained earnings $600,000. In the second one, they would have decreased, again, common stock $300,000, decreased additional paid-in capital or paid-in capital in excess of par $1.5, and they would have a new account paid-in capital shares repurchase, which would have a $150,000 credit balance. But then, when they resold some of the shares, they would have increased common stock 200,000, increased additional paid-in capital or paid-in capital in excess of par 1.2 million. They also tell us that the company had some net income. 14 million would have increased retained earnings, 15 million and 16 million, and that was in part 2. So taking those changes, what does the company have? Well, if we subtract the 300,000 and 300,000 and then add the 200,000, common stock will ultimately have a balance of $5.6 million. Additional paid-in capital would be decreased for the 1,500, I'm calling it 1,500, but the 1.5 million, the 1.5 million, but then add the 1.2 million. So its ultimate balance will be 28,200,000. There will be a paid-in capital shares repurchased account if the shares were retired. And then retained earnings. We started with a balance of 86,500,000, decreased it here for the 600,000 loss, but then increased it for all of our net incomes for 21, 22, and 23. So it would have ended up with a $130,900,000 balance. This is at the end of 2023. There is no treasury stock because that's not how we accounted for it if we retired the shares. So ultimately, shareholders' equity, 164,850. Now, if instead we accounted for this under treasury stock, common stock did not change, nor did paid-in capital in excess of par. There is no paid-in capital treasury shares or shares repurchase. But we do have this account, treasury stock. It increased. So here's our first impact right here, 2.4. Then it increased 1,650,000. Then it decreased 1,600,000. So its balance is at 2,400,000. The only other impact on equity was a decrease to retained earnings of 200,000 from this resale of the treasury stock. So the retained earnings balance starts at 86,500,000, increases for all the net incomes through the years, and decreases for that one resale of the treasury stock. So its balance is 131,300,000. Now, since we did account for these transactions as treasury stock, the debit balance in that account will decrease stockholders' equity. And we list it, treasury stock, we have 400,000 shares, their cost, 2,450,000. After we do the accounting, take a look. Whichever way we account for this, total stockholders' equity will be the same. It doesn't change. Overall, it's still the same amount. It's the details that change inside. So it all depends on how the company chooses to account for those shares they're repurchasing. And quite honestly, they have to be careful individually with their stocks accounts, just because from a perspective of if they have any loan covenants that may stop them from retiring shares of stock, they may have to keep a certain overall level of common stock or paid-in capital in excess of par because their creditors require it. Other than that, you have to remember something. If you're like, well, maybe they want to pay less in dividends. It doesn't matter if their common stock is retired or held in treasury. Those shares of stock are not receiving a dividend. Treasury stock does not receive a dividend. So they're not saving anything from a dividend perspective. So it really depends. The choice they make will probably be because of restrictions that they have on individual items within stockholders' equity that they may be required to abide by. But overall, the overall impact on stockholders' equity is the same. Okay, so that was a nice little problem to review. Repurchasing stock and either holding it as treasury stock or retiring it and maybe selling it later. Have any questions on that, Ken?
No, but as I go through all the work, I probably will.
Okay, well, just make sure you get me an email.
Okay.
Okay.
It seems like I have more problems with the online platform than anything.
With the Connect?
Yeah, oh, it's so annoying. I get so frustrated because they're so particular with things.
Yeah, that's the only thing. So if you know you're doing something right, like don't drive yourself crazy. You know, you could just send me an email and say, you know, I know this is what I'm trying to do here. If you're off on the wrong track, I'm gonna say, oh no, you're looking at, you need to look at it from this perspective, you know?
Like the last test we did, I messed up and I didn't have like a paper to send you, like doing my work. And then I got like such a low score. I'm like, damn it. So this time I'm definitely going to have a piece of paper to like write everything down as I'm doing it so I can send it to you.
Yeah.
Because it is a pain in the butt.
Yeah.
But I think I'll be all right.
You'll be fine. Yes. All right.
All right. Well, thank you very much.
Thank you. And if you know, this is it. So if
I know. I'm actually graduating this year.
No,
it's crazy.
This is so bizarre that, you know, you guys, well, we're, you know, usually the presentations are our last hurrah together.
I know. Well, I'm still going to be back in, well, if they open back up, I'm taking classes online and then I'm coming back in the fall to take some more classes before I go. I'm probably going to go to Misericordia. So I'll probably see you around.
Okay, that sounds good. But if you need anything, you're looking, you know, with jobs and stuff like that, just let me know. And see that Lane Hamilton Lane?
Yeah, I was looking at that. Is that like I really didn't like do much research on the company or anything, but I like did a quick look. Is that like insurance?
Yeah, it's financial service.
Okay, financial service.
Prudential.
I didn't really go into that because I don't think that's the kind of like the way I want to go.
Right.
So I kind of I didn't do that that Zoom meeting or whatever they had because I was like, I don't think that's what I want to do. But I appreciate it. Thank you.
No problem. But if there's anything you need a reference or anything, just let me know, okay?
Yeah, I appreciate it. Thank you very much.
All right. Hey, you take it easy.
All right, take care.
Okay.